Good evening, everyone, and welcome to Morgan Stanley's virtual Asia Pacific Summit. This is Sumit Kariwala, India Bank's analyst at Morgan Stanley, and I'm glad to host this interesting session with HDFC Bank. It gives me great pleasure to introduce Mr. Srinivasan Vaidyanathan, Chief Financial Officer at HDFC Bank. Srini joined the bank. Srini has been the CFO for over 2 years, and before that, he had a long stint with Citigroup for almost 27 years. He has held various regional and global leadership positions in diverse geographies such as Singapore, Hong Kong, New York. Before I pass it on to Srini, I'll read out the standard disclaimer. Please note that this event is for Morgan Stanley institutional clients and financial advisors only. This event is not for members of the press. If you are a member of the press, please disconnect and reach out separately. For important disclosures, please see Morgan Stanley disclosure website. Please note that this meeting and your questions will be recorded and may in certain circumstances be distributed to clients and or made publicly available. By participating in this event, your consent to such recording, distribution, and publication is recorded. Please note that this meeting is 50 minutes long and we'll have time for Q&A. I'll take some questions initially and then open the floor. Before we start, please mute your mic and add company name to your username. This will help us maintain the attendance record. Now I'll pass it on to Srini for some opening remarks. Srini, if you can open up and we'll get into Q&A thereafter. Over to you.
Okay.
Thanks a lot.
Okay. Thank you, Sumit. I really appreciate the opportunity, and thanks to the participants for joining in today. With that, maybe I can give a short intro in terms of where we have come and what we are heading. One is certainly from a COVID kind of a big event that had been one of those big things over the last 18 months or so. I would say that more or less behind, let's call it. We need to give it, I guess, a few more months before we can say we are fully behind. But at least for most part, things seems to be quite normal from that sense. 10,000 cases a day approximately. While 10,000 cases is a lot, I don't want to belittle that, but considering that more than 1 billion vaccinations have been done and more being done, 3-4 million a day being done, that's quite an achievement in terms of protecting, at least getting the health scare behind us for most part. From this, then that turns into what the economy is and so on. So I guess when we go along, we'll talk more about it. But certainly things are opening up to get to some kind of a business as usual semblance. With that, maybe Sumit, I give it back to you, and we can talk more as we go along in terms of the interests that you or the others have. Yeah.
No, definitely, Srini, we can do that. Let me try and cut this session into 4 or 5 pieces. Let me start with loan growth first. So Srini, you saw the bank saw very strong acceleration in retail in the second quarter. Just wanted to understand how are trends in current quarter. Have you seen some pickup in auto sales, for example? And if you can also highlight an update on credit card issuances, revolve rates, discretionary spends. Some of these things on the retail side will be very helpful.
Okay, very good. Let's go through these things. One is from a retail segment point of view, then we'll look at each one of them underneath that. It has bounced back across various product lines. So if you think about it, secured, unsecured, payments category, right, broadly. And then we'll go into individuals to see how they are all doing. But all of them seems to be back in terms of very good buoyant growth that you're seeing there. There are a few things that are happening underlying, right? One is to do with the penetration, the credit itself, the penetration is very low, which we have seen even pre-COVID, that always the demand outstrips supply. So that means we can take what we want and we can leave out what we don't want, right? So it has always been a situation of what is it that we want to grow, not is it that what is it that we can grow. What is it we want to grow? That is where it was always, right? We take some things and leave out some things. Now, if you think about unsecured, good deal of demand in personal loan, in card spending, card revolvers. I wouldn't say that even last quarter I described, right? The card revolvers have not bounced back. It will come with a lag because the spends have started to come back on track. Then the revolvers will come subsequent to that. And also, you know that until late part of this quarter, even our credit policies were tight enough, not allowing line increases or not allowing other things, because we have been cautious and we wanted to go slower opening up. And after the COVID, immediately we didn't jump out of the rails and run, and we gave some time before we got on. And so we right now we are back into good pre-COVID type of policy level, and so we should see that. But it will, that the revolvers will take time, right? A quarter or so it should take, or even 2 quarters for that to come back on track, which is what you're seeing in other Western markets too, very similarly, that you're seeing that the spend always is the lead, and then comes the revolver post the spend, right? Which is what we are seeing from that cycle on the cards. On the unsecured, that goes out of the block right away, and we have been seeing good amount, both including the government segment and the other salaried segment we are seeing. On the secured front, mortgages, right from the time period of last year's October, November, December onwards, when the government induced a lot of real estate transactions through stamp duty reductions or other local tax registration tax reductions. It took off very well, and from then on it has been quite good. During that brief period of the wave 2, it was much less, right? There it was much subdued during that period. But subsequent to that, the real estate is doing phenomenally well, and is leading the way from that sense, which augurs well, because it is coming after almost 5 years from a cycle stagnancy, from turning off and going. So that's on the secured real estate part. Now, if you think about the other that you touched upon, the auto. On the auto secured front, while there were supply chain disruptions and so on, we did have good, robust growth in the quarter that went. And we are seeing reasonable levels, right? Again, inventory clearance is one. A used car is another one that we are seeing good. But as we speak this week, we have heard from manufacturers that the supply chain disruptions are more or less behind, right? It's not fully behind, but more or less. And they are expecting within a couple of months for productions to get back to business as usual or normal levels from the manufacturer's side. And so we expect that also to be bubbly and kicking and going. So if you think about our across retail, all the product segments, by and large, that 5-6% sequential growth that we are talking about is across most of those product lines in the retail that we are talking about. That is what is the demand that we are seeing, and that's the way our loan growth experiences across all of those on the retail.
Got Srini. And just on the corporate banking side, there have been some pickup in repayments over the past 2-3 quarters. How long can the pressure continue?
Okay, good. And that also, by the way, the corporate banking thing you mentioned also demands or incites the comments on the commercial and rural, because that is a corollary coming from there. So I'll talk about both. So on the corporate segment, few things. One, they ramped up, the corporates ramped up liquidity during the initial part of the COVID cycle, because not knowing what to do, they were in the position of strength. And so they wanted to be at that position, not knowing what is coming, with high levels of liquidity. We were participant in that, and you saw our volume growth during that time period too, which is very good. However, they have now started to de-leverage and pay back. 1, 2, they have moved a good part of the credit, because the position of strength moved a good part of the credit demand into the supply chain and the distribution chain, which is what I'm going to talk about, the commercial and rural after the corporate cycle, right? So that's on the corporate that has happened. 3, the corporate segment has, from a capacity utilization, if you see, is in the mid-60s. So you'd say that the working capital has also come down, and we expect that to be coming back on track soon, right? Because you would expect that the capacity utilization goes back to 70 and 75, and it should be there. From their capacity augmentation, we need to wait for some more time before that comes in. But then the infrastructure spending from the government, which is, there are good signs of, early signs of that taken off. And also, if you look at the comments from the ministry in terms of they will spend the fiscal budget and the revenues in the fiscal budget are tracking to plan and so on. So that shows that the infrastructure spending that has started will take off and go. And we expect the corporates to follow soon on that front. So at this moment, while the corporate loan growth is subdued, but we expect that to come back soon. And you know that our corporate book has got almost 30% or so term lending. And we are one of the largest financiers for various infrastructure projects in the country. And so we are there, ready, present, and waiting for that cycle to come and take. And we'll be there to finance that, right? But for the moment, we need to be waiting and watching on that front until they come to make those investments. Then that takes to that commercial, because some of the supply chain, the distribution chain have been, we created that in anticipation of what we were seeing things happening, in anticipation of big demand coming into that segment. In the Future Ready organization in May, we created that new organization, commercial and rural, by taking certain segments from the wholesale and certain segments from the retail and putting it there and focusing it for the growth. And in the recent quarter that went by, and it continues today, that they have a 6-7% sequential momentum growth. So year-on-year growth is not something that we should be focused on now, because you will see that year-on-year could be subdued. In 2 quarters' time, you will see that year-on-year will be robust. But it doesn't mean anything, but what means is the sequential momentum is what tells you is the momentum moving up or not, right? And how are we participating in the sequential momentum? Which is why that the 6-7% I've talked about commercial and rural is the sequential momentum, which is very good on that front. Again, driven through 2 things that we are trying to drive there. One is geographical expansion. We are at about 450 districts or so where we do the small SME lending. We are the second largest in the country after State Bank, and soon we hope to take the first spot on that front. We want to operate out of the 640 districts in the country. We want to operate in 550, 600 districts in the country in this commercial and rural banking. So one is the geographical expansion, because that is when we can support the corporates in their supply chain and distribution chain. We want to be participating wholesomely across the country, not to say that these kind of geography in the country we don't, and the rest of the geography we participate. No, we want to participate across everywhere. So we try to make that expansion. And second is the RM. We need to add RM because we're bringing the same style and the same kind of an approach as we do with corporate in terms of relationship management, in terms of credit assessment. And so they SME, they like, that's the differentiation we bring versus another public sector bank, is to bring that relationship management, the credit appraisal process that we have, an outside in view that we provide to the SMEs. They love it. That's what they want to have. So they can get a perspective of what from an outside in that we can give them. And if there are any blind spots or certain things that are opportunity, they can tap well into it, right? So they love that conversation and engagement with our RMs, which is what we do. So we are adding more RMs into it, into the segment. So these are the ways we are trying to grow, and we are well positioned to tap that market, and we see continued momentum in the commercial and rural segment too.
Got it, Srini. Srini, if I can just ask you, you've talked about some visibility around pickup in capex over the next few years. Will that be a fiscal 23 event where corporate loan growth accelerates quite meaningfully, or because credit growth is a lagging indicator, one would see all of that falling out in fiscal 24? What would be your best guess on that?
Yeah. See, some early amounts can come in even January to March time frame, which is even the FY22. Some start must be there, right? And not wait for the FY23, but certainly FY23 should be quite buoyant on that front. So it is not a lag after a year or 15 months. When I say a lag, probably a couple of quarters lag after we see the government take off and come.
Srini, and if I look at last 10 years, and HDFC Bank has grown by roughly 24-25% in the first 5 years, fiscal 11 to 15, around 20% fiscal 16 to 21. And this was when the system loan growth was not doing that well. Now we're talking about system loan growth accelerating. So how should I contextualize HDFC Bank's loan growth in this framework? This time you'll have the system loan growth as well. So apart from market share gains and distribution capabilities, you'll have system supporting growth as well. So should we expect more like 19-20% growth over the next 4-5 years?
See, more than that we don't give one particular number of an outlook or even a range of outlook, but I want to tell you the momentum, how we should think about it. The 16 to 21, a 5-year block, our loans grew by 2.4 times or something. And 2011 to 16, our loans grew by about 2.5 times or something. Call it a high teens, right? That's a kind of range. We expect that momentum. So that means, and if you go back to another 5-year block before 11, so if you go to 2006 to 2011 type of a time frame, we were more than that, right? So you can call it quite high teens to 20s type of growth. So we've been growing. The only point I want to make is that we see no reason not to think about that kind of an approach to growth. And how can that happen, right? Our market share after all of this, right? Doubling over a period of several 5-year blocks. If you see, is about 10.5% or so. That is our market share across the system in total sense. The public sector banks, if you look at their market share, is about 70-odd%, 70 plus something, right? That is the market share from public sector banks. So as the economy is growing, so we have that opportunity to capture the growth that is there. And the second one is the capture the market share from the competition, right? From public sector banks. So both of these, which have been the kind of a recipe from the past, should continue in terms of how we think about executing to this. And there are a few other things also that go into how we continually manage to execute, right? How we raise the bar internally in terms of our execution. Think about the 10.5% loan market share. There are geographies, product segments where we are more than that, right? Including RMs. When we benchmark RMs, when we benchmark geographies or segments, we are more than the 10.5 in some cases, which means there are some other geography RMs and segments which are below the average of 10.5. Continually, what we do is that we try to bring the ones below the average to the average, right? So that is the first level of benchmarking to focus in terms of execution capability to bring there. The second level is the moving to best in class, right? So if you see, if somebody is at 15, 17 in a particular product in a particular geography, that is the best in class. So you move everybody who's at below that best in class into the best in class to go there, right? So this is how continually you bring some efficiencies into the execution process and try to move the whole average up. And that process continues. That's how we were, and that's how we are in terms of how we are trying to drive that into that category. And the same holds true for deposits too. It is on the deposit front, exactly the similar approach in terms of getting the market share and bringing and one other thing that happens is that once a customer comes in on any product, retail or wholesale or commercial comes in, and any other product that the customer needs, it's available on the shelf with us. So one of the broadest product suites that we have in the country is our bank's product suites that we have. So generally don't need to go outside to bring anything in. Once you come in, we are there for any kind of product. And second thing is that we have consistently provided this over the life of the bank, which means not one cycle we are here, another cycle we are out, and third cycle we are in. and or another credit cycle we exited. None of that sort. We have consistently provided that. So these are the kind of underpinning that has enabled in the past, and all of this from our capability, from our approach to execution, consistently it is there, and that is what you should expect us to drive to.
Let me ask you this question a bit differently. If I look at the last decade, some of the large private banks or some of the large state-owned banks were not that aggressive on growth because they were going through a corporate asset quality cycle. But obviously they've recovered from that and now they're looking to grow as well. When you look on the ground, do you see any difference? Do you see greater challenge than what you saw in the past 5-7 years? Or because of your expansion into interior India, your comprehensive product suite, those challenges don't worry you?
Okay, it's a good question. Good question to that. But one thing I do want to tell you or bring to light is that 2016 to 21 or 11 to 16 has not been a cakewalk, which means it has not been something that was a runaway. There is nobody on either side of the flanks, so you run. It was not. The competition has always been good, very respectable competition, albeit they may have had some segments in which they may not operate, or some products they were not operating, or at the level at which they need to go, whatever it could have been. But then it is not correct to think that there was no competition or we were easy on the lane. I wouldn't say that it was easy on the lane. The competition was always there, right? But our execution, first our people, we've had tremendous kind of people skills, that people knowledge that they were executing to it very well. And that continues. That's a machinery that continues. So if you ask Shashi today, what do you think, what was the success in the past and what do you think is happening today? He'll say, it is all about execution. It is nothing about products or nothing about strategy or is nothing about anything else. It is about how meticulously one follows up to get things done. So on the retail level, on the wholesale level, across, that is what makes it happen.
Karshini, let me ask you a question on margins. And HDFC Bank obviously has a much higher fixed rate book than some of the other banks in India. As interest rates move up, how does that impact your margin profile?
Okay, again, another good question, right? See, the way, if you think about our margin, how it has moved over a period of time. So first of all, long period of time, and then we'll come to a short period of time. Over a long period of time, it has always moved between 4.1 to 4.4 or so. That's, call it 40 basis points in that range. That's where it has moved all the way. If you can think about a 5-year block or a 10-year block or a 15-year block, when I map and see, it is within that band. That's where it has moved, right? That's one thing. Now, in the recent times, it has moved. It has operated at the lower end of the band. And if you think about the composition of the loan mix between retail and wholesale, the wholesale rate is much lower. The yield is lower because of our selection of highly rated corporates. So you have a risk-based pricing that you do to have it in such a way that you get the right kind of customer that we want at the price that we do. Risk-based pricing brings that. So now that the retail corporate is somewhat moderated and the retail is moving up, as it moves up, the yields on a total basis should go up too, right? You know, most of the retail book is a fixed rate loan. So it should start to move up in line with that. Whether it will take a couple of quarters to go there, yeah, we'll have to wait for a couple of quarters before it starts to get on. But when the wholesale started to grow, if you think about 18 months, 24 months ago, it took that kind of a time period for the NIM to come from 4.3 to 4.14, right? It took that time. So it will take a couple of quarters or 3 quarters to get back up into that kind of a range. So that's how you should think about the net interest margin, the way it should go.
That's helpful, Srini. Let me ask you a question on asset quality. So during the past two COVID waves, your asset quality has behaved very well, and you've grown very calibrated in a very calibrated manner. Even on the retail side, last 3-4 years, if I look at the share of corporate banking on the book has gone up. So logically, as the credit cost, as the asset quality cycle turns, the credit cost should logically undershoot what you've been seeing over the last 2-3 years. And uh, you don't report credit cost net of recoveries, but if I look at the recoveries, that number obviously has been doing quite well and should pick up further. So my question in that backdrop is that as you see credit costs undershooting estimates, what are you going to do? Are you going to build floating provisions like what you did at the start of last decade? Would you invest more in cost, or will that flow into bottom line?
I'll tell you the way we think about it, right? One is as the quality gets better, it's at a quite a robust level. 10-20 basis points, can it swing? It can always swing. That is within normal range that you would expect that it can move up or down around. But from our approach point of view, we would like to keep the balance sheet as resilient as possible for any kind of an event, right? Which means not that we expect another COVID or something else like that, but if anything were to come, we want the balance sheet to be much more resilient. And so it would be our endeavor to keep the balance sheet strongly reserved. That is one thing. To keep that, I want to leave that, right? Within reason, within accounting, audit, and all, and so on and so forth. But it has to have within reason, right? That's where we would endeavor to do. The second thing that we would endeavor to do, which we alluded to in the recent quarterly call also, which is we are expanding our experiments. See, at any time, during the COVID, many things were curtailed, right? But pre-COVID, we did have many kind of an experiments that was running at any time. Either it is going on the edges of the segments, or it is the geography, or we are getting certain products to certain segments that we weren't getting, right? So there were several experiments that we were running. It could be new to bank experiments too, right? So several things that we were running, and during COVID, it didn't happen. Now, in this cycle, our innovation lab is pretty active right now. So that's the point I was wanting to say when you talked about the investment. The investment is not just about expenses. I'll come to that. It is also about getting the innovation lab to work and do various experiments. And it will have an implication on credit, but it can't swing the credit in a big way. Can it impact by a few basis points? It can. But that's part of the investment strategy that we are having, which is we want to be expansionary and participative and take that luxury of experimenting a few things. Half of them succeed, we are able to scale it up, and other half don't succeed, we'll call it, we tried, we failed, we'll move. And at least that's one thing. So from a credit card of Jimmy has been persuading me to say, Srini, when are you going to start talking about the impact of the experiments on the credit line? I look for a tighter process in terms of how I can dimension, and we'll do that. But at least I want to leave the thought with you and with others that yes, the investment spending also has got an implication on the credit through our innovation lab. Now, coming to the other aspects of the investments, right? Yes, in an expansionary cycle, as a natural kind of a process where credit gets benign, you do want to be participating in various investments. We have been opening branches. We continue to open branches, and we will, as I alluded to, we have a few hundred branches that are already ready state to go, and we will go with them. And then while in some other markets they may be curtailing branches, but our country is not at a stage where we can say that we don't need branches. Despite strong digital approach, physical branches are required. One, for brand building. Two, as a congregation place for our sales force. And three, they do some basic banking services too in the branches, right? It's not for nothing. They do certain things in the branch to close out various things that we, customer activation and other things that we do. So yes, we continue to make investments in branches, investments in people. And it has got a gestation period, right? For a branch to turn around and go could be a couple of years. For people to get to productivity it could take 6 to 12 months depending on the job and the segment, the product they are operating. We are making those kind of investments, and we'll continue to make those kind of investments. It's the right time to make those investments to bring up people on the curve. So I want to leave that with you. The investments, yes, we are vehemently pursuing, and we are also experimenting in various products and geographies and segments in our innovation lab.
Got it, Srini. I've got a lot more questions, but what I'll do is I'll just open up the session for questions from investors, and let me see if there are any. So any investor who wants to ask a question, please go ahead. Jishan, I see you. You want to go ahead, please?
Hey, thanks so much for the time and the opportunity. Just a couple of quick follow-ups. So on the NIM side, we'll talk about it takes maybe a couple of quarters to get back to where we are. So can you maybe can you elaborate on how things on the ground recently? Is it reasonable for us to expect the September quarter be a trial quarter? And also, what are the tailwinds or what are the potential upside and downside to the NIM?
On the upsides and downsides to the NIM, to the extent that the retail growth, which we anticipate to be faster from a build momentum point of view compared to the corporate book, we would expect that our pricing power and the product yields are far higher than the corporate, and so things should move in that upward direction. If the downside is that if the retail don't happen, you will see that it doesn't happen, right? But we are seeing good amount of buoyancy on the retail front. And so another way to look at it is, which in this quarter I started to talk about it, if you think about our risk-weighted assets as a denominator, right, on our net interest, it has been rock steady at about 6% all the way through, right? So it is a function of what is the kind of an underlying asset which you are having. And so accordingly, when we have the risk-based pricing, you see that the pricing is appropriately done. So on a risk-based, on a risk-weighted asset basis, we've been pretty steady over a period of time. And so that's how you should think about it.
Got it. Thanks so much, Srini. Next one is on the OpEx front. We are obviously investing in growth as things start to open up. So how should we think about any ballpark figure we can expect for full year OpEx growth? Are we seeing more salary increase or any backlog on that front in the second half? And also, are we stepping up our IT kind of investments in the second half versus what we saw recently?
Yes, the answer is yes to all of them. We are making investments in people, investments in branches, investments in technology, right? All of them we are doing. Now, what does that translate into? Where does this go to, right? And we are making investments in sales and marketing, right? Where does this go to? If you think about it, our retail cost to income is much more than the average, right? Our retail cost to income. Our wholesale cost to income is much lower than the average. So with the retail growing faster, momentum taking off and faster than the wholesale, you will see that naturally it goes up. And that's how it came down. We were pre-COVID, we were at about 38.7 was our cost to income before the COVID time period, right? If you go back to December 19 or even March 20 for that matter, that quarter, it would be about that kind of a level. And you should not look at cost to income quarter to quarter or net interest income or margin quarter to quarter. That is not what, we don't even look at it. I do almost 2 reviews a day with various businesses, not a single balance sheet or P&L discussion we have, right? We look at the implications of the products that are made available to the customer and how is the momentum. That's what we do. So I would not encourage you to look at quarter to quarter any of these things. But however, if you go back, that's the 38.6 or 7 or so was the number. Slightly shade under 39 was the cost to income. Now, when the wholesale came up and the retail came down, the cost to income almost came down to 36 in one of the quarter period, and then now last quarter was 37 something, right? As the retail picks up, you would see that because the retail cost to income is higher than the wholesale cost to income, because we have more upfront marketing, more sales, more cost of acquisitions on those, right? And the accruals income come over a period of time. And so that will start to go up on that front. And then at some point in time, if it gets back to pre-COVID, which is 39, I won't be surprised, and we'll get there. However, in the medium term, normally we don't provide an outlook, but on the cost to income is something that we have consistently said before the COVID period, and I'm now telling right now too, which is we're quite confident to drive that to mid-30s over a period of time. In the medium term, 3-5 years, you should expect the cost to income to get. How does it get to? One is the scale. As you get more scale on the front end and you keep the share, you keep the revenue growth more than the expense growth. Again, not quarter by quarter, no? Over a period of time, you see, when that happens, you'll see that there is a natural leverage, operating leverage that is coming in. That is one reason. The second reason is exactly the investments that we are doing in technology that is supposed to bring the cost of acquisition down, right? One of the significant push that we have is the digital marketing, digital acquisition, as opposed to a branch-based, VRM-based, a physical sales force or a physical DSA. Now we have a digital DSA and we have a digital marketing, right? So as we get more and more through the door on the digital front, the cost of acquisition goes down. And more and more we automate and move towards a self-service model, the cost of servicing goes down, the unit cost of servicing goes down. And so that is how we expect, and that is what we are driving to get to that kind of level.
Got it, Srini. So basically, near term, as the retail grow higher than corporate, we will see cost income go up, but as a corporate pickup, we will start to come down.
Absolutely. Yes.
Yeah, got it. Thank you so much. Thanks for the opportunity.
Thank you. Thanks for asking. Very good. Thank you.
Hi, anybody else has a question? Please go ahead. Penny, just waiting for somebody to come back, but until then, I'll continue with my question. So
yes, go ahead.
One of the questions that I had was on the restructured loan portfolio. And we saw some slippages in the previous quarter coming from the restructuring that was done in the first COVID wave. What's your outlook here? And do you have some early trends on how the loan restructuring that was done post the second COVID wave, how is that portfolio behaving?
Okay. See, the background to our restructuring itself is that we've been as magnanimous as we can be. We put it up a lot on our website, inviting customers to take opportunities where they have health issue for self or family. You know that this particular COVID wave, where the restructuring 2 came in, was not an economic issue as such in the country, right? Even from an output point of view or spend level point of view was very limited. It was more a health issue that happened. We did not see much job losses. You know that 80% of our unsecured loan is to salaried customers and 70% of our card is to salaried customers and so on. And there are no meaningful job losses at all through the cycle. It was more health related items that were there. And as people came and asked for restructuring, either because they have a health issue or they want a better cash flow at their end, we've been quite okay to provide them after analysis. That doesn't mean to say that we don't expect any losses from there, right? And then whether it can, that is what we in the quarter end also we said that, hey, 10-20 basis points, can it swing at any point in time? It can swing 10-20 basis points at any time. But certainly that is a portfolio that will be under our closer watch for us. And both from a credit monitoring point of view, as well as from a collections point of view, as soon as if something comes, the collections will be all over it. But 10-20 basis points can happen, it can happen in that portfolio. But we are quite confident that that is the robust process, and the right thing to do for the customer is to give that opportunity when the restructuring window was open.
Fair enough, Srini. Shrini, can I ask you a few questions on the digital part of the bank?
Yes.
One is on the HDFC Bank collaborating with fintechs, and unlike history, we're seeing HDFC Bank doing a lot more tie-ups with various fintechs and various categories. Would you like to just talk about some of those initiatives and how will this play out over the next 2-3 years?
Yeah, very, very good question. Very topical, and because that is a very strategic kind of a move on that front, right? One is the underlying to keep in mind is that the fintechs are not competitors to banks, right? And banks are not competing with the fintechs either. So, in the sense that it's clear on both sides that one is not treading on the other's shoes. So that is not what it is. So then that gives rise to how can you leverage each other? That is the next thing, right? Okay, if you both of you feel they're not competing, then how are you going to leverage each other for the benefit, both from a country benefit, but from a customer benefit, and thereby the bank has to benefit and the fintech has to benefit, right? So it has to be win-win for all. So how do you do? That is what this partnership is all about. If you think about, we have a branch channel, we have a VRM channel, we have a Salesforce channel, feet on street, attached to our product group. We have a channel. We have a physical DSA channel where people, there are, CSC is an example of a physical DSA, although they deliver digitally, but physical stores they have. Like that, we have various physical DSAs who run stores, who run shops, who are there. Now, these fintechs are nothing but a digital DSA, right? And the customer is our customer at the end of the day, because we have to do the KYC. Just because it comes through a digital DSA channel doesn't mean we are absolved of everything that the bank is expected to do. So we'll have to do the KYC, and we'll have to do the AML monitoring and reporting. So none of that goes away. So that means we own the customer and we do the things that we normally do for any other channels customer that we bring in. So that's one thing on that front. The other aspect of the digital channel is that there are, what is it that we can do through this channel? They have clearly, these tech startups or fintech players have very good UI UX. They give greater customer experience, and one of the USP for which they're able to attract people onto their platforms, right? That is where we want to be partnering to bring them, right? So if somebody is going to any of these sites, we don't want to be sitting here waiting for the customer to come and hit our website, our mobile, our net, or our branch, or our other systems. We want to go and bring the customer from some other platform where they are doing a transaction at the point they are doing a transaction, right? And not wait after. So that's the kind of a theme on which we operate. So let's take some examples of what can happen in this kind of a partnership, right? One is liability. None of these fintechs are a bank. They cannot gather any liabilities. So we want to be the predominant bank in the digital DSA channel to bring in the liability relationships. So that is one. And for whom it can come. It can come for the merchants. Some of the fintech players have some merchants. Those merchants could be simply shopkeepers. Those merchants could be some of the SME players, right? Either even small manufacturers, small traders, small shops, whatever they are, right? So we want to be having the liability relationship of them and their ecosystem, which is their family and their own personal and so on. And the second thing is that to the extent that these merchants are also payment acceptors, right? So if it is a QR code acceptor, you're there, Sumit? I'm there.
Yeah, we're there. Shrini, please continue.
Okay, no, because the screen came with something else. That's why I asked. Yeah. Okay. Yeah. So these payment, if they are payment processors, or if they're accepting payments, we want to be in the front there to make them accept our more credit card, debit card kind of a payment instead of only a QR type of payment, right? So that means the payment, our payment merchant acquiring wants to be there. Right. The second thing is that the third thing is that it's in relation to the loans that we could offer. We want to be, once we have the liabilities, we are processing the payments. We also want to make a lending value relationship, like the way we do the sandwich strategy in the merchant acquiring. The same way is what we are addressing it here. The next thing is the individuals who come on there, right? Individuals will come on there. Today, the fintech players are operating at a segment which probably the bank will not operate. A small ticket size, 1,000 rupees, 2,000 rupees loans, we call it $10 to $20 loan size, right? That's where probably the bank wouldn't operate. However, that doesn't mean that these fintech players do attract certain other customers who are bank target customers. And so that is where we want to be participating to say, because we can offer the scale. Fintechs don't have a lending. That means they don't have a liability, deposits, nor do they have a debt on their balance sheet. It's all private equity. And so we want to be there to have the scale so that it can be scaled up meaningfully from a bank scale point of view. So we want to be having the lending. If it is our customer, it's very easy, instantaneous decisions, because we have the algorithms that will instantaneously return a decision for them to get the credit on the fly. If it is not our customer, then this is where some of the fintechs who got data comes in monetizing the data. So along with non-customer non-customer of the bank, if anything that comes, we are experimenting in our sandbox where we take the data in and we try to score based on the data that we bring in, based on the transactions with the fintechs, bring a scoring algorithm to make an offer on that. So across individuals or merchants, across all of these spectrums, lending and liability value, that's where we are trying to work with to get these done.
Very clear, Srini. Srini, can I ask you a question? Maybe this question should be asked by me to Parag, but just trying to see your views on this one. There are a lot of new fintechs who are entering in the credit card business in one way or the other. And some of these players are offering a lower interest rate, or they're helping customers convert into term loans, reduce the revolve rate, etc. Do you have any thoughts on this? And is that can this impact the potential, the profitability of your credit card business? Any thoughts on that, Srini?
Okay. See, anything that happens in that arena today, including the BNPL or even a card-based, non-card-based, anything that is happening there, is of a very low ticket size, right? One. And number two, they're probably not at the bank segment level, right? It is much below the bank segment level. That's where they are. And so we are quite happy to leave it some of those things, because these new to credit, new to bank can be cultivated by some of these players well. And once they come to a certain standard, we are there as a bank to provide much better value proposition from a holistic relationship point of view, both from a ticket size and product breadth point of view. We are quite happy to have that. So the point is that most of these are small ticket size or a different segment. Let them handle that. And once they get in, then we are there, because none of them can scale up. Without a liability value proposition, none of them can scale up. Without a collection capability, none of them can scale up. So think about it. After 20 to 23 years or so of retail, right? After the first 3 years of our bank, more wholesale, we have built up a collection sales force, both in the bank and outside through third parties, more than 45,000 people, right? In addition to various other digital mechanisms, we do want that kind of, right? You can say 97% are digital repayments, correct? It's the balance 3% that matters, right? Where you need capability for collections to get it done. And so that's, these are some of these kind of, apart from regulatory modes, right? The regulation has to allow certain things to be done for the fintechs. In addition to all of that, I'm talking about the banking mode itself, right? In terms of the liability, in terms of the scale on the assets, both the ticket size and the breadth of product, and in terms of the collection capability. These are the things that are more important for execution. And so small ticket size and certain things that are done as a hobby, we'll leave them on the side.
Got it, Srini. I have more questions, but in the interest of time, we'll have to conclude today's meeting here. Thanks a lot, Srini. Thanks a lot, investors. We look forward to having you again. And if you have any questions, please do not hesitate to contact us. Thank you for joining us today.
Thank you. I appreciate engaging, and good to talk to you, Sumit, and all the participants. Thank you.
Thanks a lot, Srini. Thanks, Ajit.
Yeah. Bye-bye.